Hi guys, I hope you're all okay. So today's class, Mwalimu wants to handle a question that majority of you have been asking Mwalimu a lot. So this question basically, and I'm going to base it on a question which was attested, of course, in August 2022, question number 5, part B. The question is all about the concept of valuation of ordinary shares, but the whole idea here will be looking at valuation of ordinary shares in a supernormal growth firm. This question, majority of you have been asking Mwalimu a lot. How do you go about such a concept? And that's what I want to share with you today. And to that note, basically, because of your request, these are what you're doing. We know very well that the economy is at the corner, right? All of us, we are crying, right? So this is what we are doing. If you are outside there and you're doing financial management, regardless of the course that you are doing, should it be CASNEB? Should it be NEC? Should it be maybe you're doing, say, like you're doing a paper maybe in your, of course, in your bachelor's, right? Aspect of maybe talk of a degree or master's. Regardless of whatever that you're doing, and basically it has a concept of financial management, ACCA, regardless of the course that you're doing, and it has financial management. My good students, this is the offer I'm giving you guys. You can get all the videos of financial management. That is, all the videos entailing all content of financial management, literally from topic 1 to the last topic. We know very well that probably here aspects of maybe a course outline varies from course to course, but the basic concepts of financial management. For CASNEB, students are going to be lucky because it is what is has been aligned as per their syllabus, right? So if you're doing financial management, this is an offer for you guys. Ideally, all the tutorials for this course, we normally tend to charge 4,000 shillings. This is our original price. But what we are doing from now, from today to the next 1 week, right? From today to the next 1 week, I'll be giving you guys this course at 2,000 shillings, 500 to 500. You get access to all these recordings. So if you are lucky within this 1 week, you're going to enjoy and get access to all these classes at this price, only 2,500. How do you go about it? Log into app.mdarasa.co.ke, right? Log into app.mdarasa.co.ke, whether you're using your phone or if you're using your PC. This is an offer that actually you can't let it go just like that. So you get access to all the tutorials for financial management. You get all the tutorials for financial management. So this is an offer that basically you can take an advantage of for this next 1 week, at 2,500. So looking at this concept, that aside, looking at this question, April 2022, question number 5, I want to take you back first of all. Remember, at any given point, whenever we are looking at basically financial management and you're talking of valuation of ordinary shares, for valuation of ordinary shares, we normally tend to have various methods, right? We normally tend to talk about price earnings ratio method. We normally tend to talk about net assets method. We normally tend to talk about Gordon's valuation model. So under Gordon's valuation model, you'll find that we normally tend to talk of aspects of the 3 concepts of firm, right? We normally tend to look at these firms. We normally tend to talk about aspect of this is Gordon's valuation model. Under Gordon's valuation model, which also this one is always referred to as what? The dividends growth model. The dividends growth model. We normally tend to talk of 3 main. Number 1, we normally tend to look at a case where we are talking of the normal growth firm. We normally tend to talk about number 2, aspect of that is a non-growth firm. And finally here, we are talking of supernormal growth firm. Supernormal growth firm. So at any given point in time, whenever we want to value our ordinary shares and we are using the dividends growth model, or rather the Gordon's valuation model, this is what we must always tend to remember, that I'm having three concepts: the non-growth, normal growth firm, and supernormal growth firm. Where if at all you were to talk of the aspect of the non-growth firm, at this point it normally assumes that at this point the investors literally, they are going to be paid a constant value of dividends throughout. That is to say, this company will always make profit, right? An assumption, this company will always tend to make profit. So to determine the non-growth firm, in this case our PO, we normally tend to talk of the value of our ordinary, shares, that is our PO. This will always be simple because I'll always be talking of our D1 here, of our KE, cost of equity, D1 of cost of equity. So this is what? This is for the aspect of non-growth firm. Ideally here, the dividends are constant all through. Recall the concept of D1. If at all you talk of D1 at any given point in time, ideally we are talking of expected dividends, right? And on the expected dividends, my good students, literally, we are talking of in the event that you are required to determine our D1. D1 is always about us taking our current dividends, which is going to be represented by DO of 1 plus G. G ideally is our growth rate. And at this point, you're saying that we don't have growth rate. Growth rate is zero. Growth rate is zero for non-growth because the dividends will be constant all through. So in such an event, you'll find therefore it as if now we are talking of, in this context, my D1 will just be the same as what? As DO. This is in the event that we are talking of what? The non-growth firm. Dividends are not growing, right? They are constant all through. So talk of that. What about the normal growth firm here? The normal growth firm at this point normally tend to assume that the dividends, these are firms where dividends grow at a constant rate throughout. Dividends grow at a constant rate throughout. So how will we determine that? To determine for normal growth, in this case, we are going to take, of course, our D1 of what? Cost of equity, which is KE, minus our growth rate. So this is literally for us to determine our PO. These are PO where we are looking at the normal growth firm. Ideally, it's just the same as saying we are looking of DO into 1 plus G. All of these take KE minus growth. This is for the normal growth firm. This is for normal growth firm. This is for aspect of what? The aspect to do with non-growth firm. What about the last item, which our focus will be the supernormal growth firm? This is where our target is. Explaining supernormal growth firm, my good students, this is a case. You'll find that this is a scenario whereby our dividends on the initial stages of the firm, the dividends will be growing at a very high rate. The growth rate here, the growth rate will be very high, at a very high rate, say like assuming maybe 20%, right? Then this dividends growth rate is going to decline. As the time goes by, the dividends growth rate is going to decline to a point of say like 15%. As the time goes by, you'll find that it's going to decline and remain stable all through, say to 10%. So it's going to decline and it's going to remain stable all through. So the time that it remains stable, that's the time that we normally talk about what? The period of up to stabilization. That is up to stabilization. So this is the behavior. Very high rate on the initial stages. As the time goes by, the dividends growth rate will decline and then it will decline all through. It is going to remain constant all through. So the question would be, how will you determine the intrinsic value of these shares for such a firm? And that is what I want us to concentrate on today. That is what Mwalimu will want to concentrate on today, and that's why we are looking at this question for August 2022, question number 5B. That's why we are looking at this question for August 2022, question number 5B. So for us to determine our intrinsic value for a supernormal growth firm, this must always be very key, and we must always be having this at the back of our mind. We'll be talking of the present value of the expected dividends. Present value of the expected dividends up to the point of stabilization. Up to the point of stabilization. Then, my good students, we add what? We are going to add the present value of shares immediately after stabilization. Immediately after stabilization. So this is how we are going to determine the PO, the intrinsic value of these shares for a supernormal growth firm. Let us go directly to our question. Let us go directly to this question of ours here. Okay, that's a question. And at this point, for those who have the past paper, just check it out. This is a question, August 2022, question number, basically, this is a question number 5. Question number 5, part C. August 2022, question number 5, part C. Just check out that question if at all you're having your past paper with you there. So, this is a question, a very interesting question for supernormal growth firm, and I believe by the time we are through with this segment, you'll be very good in handling any question for supernormal growth firm. So these are what you are told, that Koki Limited recently paid a dividend of 2.50 per share. The dividend is expected to grow at the rate of 15% per annum for the first 3 years. Then at the rate of 10% per annum for the next 2 years, after which the dividends will grow at a rate of 5% per annum to perpetuity. Perpetuity is the period that you don't know. The required rate of return for the ordinary share is 12%. So the question or the examiner wants us to determine the intrinsic value of the ordinary share of Koki Limited. Intrinsic value of the ordinary share of Koki Limited. So whenever you are given such a questions, my good students, this is very easy, and at this point you should just be smiling. Why? Because we've said at this point I'll pick it automatically that I am dealing with a supernormal growth firm because of the change in the growth of dividends. And at that point, for you to determine the intrinsic value, this is what should click at the back of your mind. The present value of the expected dividends up to the point of stabilization, plus the present value of the shares immediately after stabilization. So how will you go about it? At this point, identifying, of course, the variables that we are having. At this point, let us list our variables. I'm given, number 1, we are told we are having our dividends, recently paid a dividend. So my DO, our DO here is what the examiner is giving us there, which is basically 2.50. Then we are told the dividends is expected to grow at a rate of 15% for the first 3 years. So the growth rate here, I'm having 1 to 3 years, is expected to grow at the rate of 15%. The next item examiner is telling me then at the rate of 10% per annum for the next 2 years. So this is basically for the next 2 years. So year 4 to 5 at the rate of 10%, right? Then we are told like after the dividends will grow, afterwards the dividends will grow at a rate of 5% per annum to perpetuity. So year 6 onwards to a period that we don't know is going to grow at the rate of 5%. Then what are we given here? The return for the required rate of return for the ordinary share is 12%. KE, my good examiner is giving us KE at the rate of what? 12%. So literally, that is the details that I need. These are the only details that we need for us to handle this question. So how will you go about it? How will you go about it? This is what I need to know. At this point, I'm going to prepare this small schedule whereby I'm talking of year 1, or rather years here. Years you're talking of 1, 2, 3, 4, 5, right? What about expected dividends? So I need to determine my D1. D1, we've said it will be equal to our current dividends 1 plus G. That will give us our D1. So we need our D1 for year 1. What will we be having here? I'm going to have the O, which is the current dividends was what? 2.50 as per what the examiner had given us, right? The examiner had given us 2.50. So I'll be having 2.50 into 1 plus the growth rate in year 1, 15%, 0.15. This will give us what? This will give us what? That should be 2.5 times 1.15 to give us basically 2.88 into 2 decimal places. What about year 2? In year 2, what will be our current dividends? Year 2, the current dividends will be the dividends for the year that we just paid, the previous year. The dividends that we've just paid, which in this case is dividends for year 1. So I'll be having 2.88 into 1 plus G, 0.15. That should give us 2.88 times 1.15 to give me a figure of what? 3.31. We proceed again. The next period I should be having year 3. So my DO is 3.31, 1 plus G, 0.15. So that at the end of the day, what will we be having? 3.31 times 1.15. This should give us what? 3.81. Right? 3.81. After that case, my good students, we proceed to year 4. 3.81. What is happening in year 4? The growth rate, it declined to 10%. So therefore, it should be having what? 0.1. Which that should give us 3.81 times 1.1 to give us a figure of 4.19. The next period should be 4.91 into 1 plus still 10%, right? 0.1. So that should give us what? 4.19. We multiply by 1.1. This should give me a figure of what? 4.61. Right? So at this point, these are the expected dividends. These are the expected dividends up to the point of stabilization, because henceforth they were at the rate of 5% to perpetuity, to a period that we don't know. Our focus is for us to determine the present value. And at any given point, whenever you've seen the present value, what should come at the back of your mind, my good student, is what? The aspect of the interest factor. So the question would be, which interest factor are we going to use here? I'm talking of present value. But which interest factor? The interest factor that we're going to use here, because I can see our dividends, they were irregular, so therefore I should remember present value interest factor for lump sum, given cost of equity, which is 12% here. 12%. It is at this point that you should remember, right? Let me remove this completely because you have the question already. It is at this point that you should remember how to determine the present value interest factor given the rate and number of years. We normally tend to talk about 1 plus R raised power negative n. And that's what you're going to apply here. That's what you're going to apply here. And Mwalimu is going to give us a shortcut. Today we learn a lot of things. Mwalimu is going to give us what? A shortcut. So let us do it. I'm having the rate which is 12%. So literally I'm having 1.12 raised to power negative 1, which in this case it will give us what? 0.8929 to 4 decimal places. I don't need to repeat this formula. If I've attended Mwalimu's Aringo's class, I don't need to repeat that formula, right? All we need to do, I'll just take whatever I have computed, I divide by 1 plus r. I divide by 1 plus r. So I'm going to divide by 1 plus r, which is, my r is what? 12%. So 1.12, that should give us what? 0.7972, right? Afterwards, see the magic. I'll just be clicking equal sign to give me 0.7118. I click equal sign to give me 0.6355. I click equal sign to give me 0.5674. That is what we should be having, right? I know at this point you will be asking, Mwalimu, kumbe that is a secret. That's why your students have been passing that much. This is a secret, right? For exam, the only aspect of enemy is time. So if you can manage your time well, then you're just good to go, right? So this is what you should be having here. So we determine our discount factor. So easily, I can determine my present value here. Easily, I can determine my present value. So how do you go about our present value? This will be very easy because I'll be taking my D1 times factor. The first one I should be talking of what? 2.88. So I'm having 2.88 times 0.8929. This should give us 2.57. 3.31 times 0.7972. In this case, I should be having 2.64. Talk about 3.81 times 0.7118. I should be talking of 2.71. The other one, 4.19. We multiply by 0.6355. I should be talking of 2.66, right? The other case I should be having 4.61. I multiply by 0.5674 to give us what? 2.62. We do what? We sum it up. We sum it up. So by summing it up, I should be talking of 2.57, 2.64, 2.71, 2.66, 2.62, which in this case I should be having what? 13.2. So what have we determined here, my good students? We have determined the present value of expected dividends up to the point of stabilization. Up to the point of stabilization, right? The next item is for us to determine, therefore, the present value of shares immediately after stabilization. So, my present value of shares, present value of these shares immediately after stabilization. How will we go about it? How will we go about it? I should be having, of course, our value, that is of course the intrinsic value of these shares during that immediately after stabilization, which will be P6, right? So therefore I should be having my formula. I know very well I should be having what? The D1, which in this case is DO, so talk about for year 5 into 1 plus G all over my KE minus our what? G here. So literally in this case, it as if you are talking of our what? The present value. This is not, these are basically the intrinsic value for that period, right? So once I have this, I'm going to multiply my good students by what? By our factor immediately after stabilization. Immediately after stabilization, I should be having what? That was year 5. So I must multiply by my present value interest factor, right? Given the rate, which is, of course, cost of equity, 12%, and talk about what? Aspect of 5 years. That is what we should be having there. So in this context, things will be very, very simple, right? All I need to do now is to figure it out. How do you work it out? I'm going to take, therefore, my D5. Dividends, this is like a D1 here, right? D1, I'm having aspect of, or rather D5 is like our DO because you're looking at for year 6, right? So D5, the dividends for year 5, which you got a figure of how much? 4.61, right? Into 1 plus growth. The growth rate here, henceforth, from year 6 henceforth, we are told it was 5%, right? So I'm having 0.05. We take our KE, which is 0.12, we less 0.05. That will not be the end. After this, I'm going to multiply by my factor, which is 0 for year 5. I'm having 0.5674. So what will you be having? I should be talking of 4.61 times 1.05. We divide by 0.12 minus 0.05. I'll be having 69.15. We multiply by 0.5674 to give me 39.23. So therefore, we add it. I should be talking now of 13.2, right? We are going to take 39.24. So 39.24, right? So therefore, what will you be having here? 39.24, we add 13.2 to give us what? 52.44. So that is how we were supposed to work out that question, right? Where we have determined the first case here, we had the present value of the expected dividends up to the point of stabilization, 13.2. We've come and taken the present value of shares immediately after stabilization, which is 39.24. Then we sum them up. So literally, this is how you're supposed to work out such questions. Clearly, if at all you find such a question, will it really be a headache to you? I know it won't. I know it won't, because literally we've looked at it deeply. So you'll find, my good students, like majority of you, you've been asking this question. And today, Mwalimu has decided, like, you know what, let us do this. And now you're having it right. Just as I mentioned when we started, we're having this offer for you guys. If at all you're doing financial management, regardless which course you're doing, and advantageous for CASNET students, right? If you're doing this paper, right now we're having this amazing offer. Instead of you paying our normal charge, you're only going to pay how much? 2,500. You access everything. The video tutorials, you access the class notes, you access the revision materials, you get access to Mwalimu for this amount. So take that advantage. And guys, let us meet in our next session as we continue basically what? Getting this knowledge of financial management. Thank you so much, and let us meet next time. Bye.